Hello and welcome. In this lecture video, we'll continue our discussion of Chapter 2. And so we'll talk about the ledger and then the chart of accounts. We'll talk about debits and credits, double entry bookkeeping, and also how to calculate the balance in a general ledger account. Okay. So we talk over here, we've had some discussions in the first lecture video for Chapter 2 about what is a ledger and what is a chart of accounts. And so remember, a ledger is a collection of all of our different accounts. And remember, an account is a specific asset, liability, or equity. So example, cash. Cash is an asset. Cash is a specific type of asset. Accounts payable. Accounts payable is a liability. It's a specific type of liability. So all of those, and then their respective balances, as in how much cash do we have, what is our outstanding balance in accounts payable, how much do we still owe in our accounts payable. All of those specific types of assets, liabilities, and equity accounts, and then their respective balances, that's called the ledger, the general ledger. A chart of accounts is a list of all of our accounts, so those specific assets, liabilities, and equity accounts, and then along with some identification number. So if we look on this next page, for example, we see with this figure, we have account number 101, that is cash. Account number 102 is accounts receivable. Account number 126 is supplies, 128 is prepaid, 167 insurance, 201 is accounts payable, 236 unearned revenue. Remember, unearned revenue is a liability. Unearned revenue is a liability. And that's a situation where we get paid up front, but we still haven't provided the service. So we're on the hook to provide the service in the future. We have a liability to provide that future service. All right. And that's what I was saying in the first lecture video for Chapter 22, is a liability is something you owe to a creditor, right? So creditor's claim on the assets is something you owe. But the liability doesn't always mean that you have to pay cash. It could mean that you owe a future service. And that would be the example of unearned revenue. If you take a look at how these account numbers are set up, see how all the ones that start with 1 are assets. All the ones that start with 2 are liabilities. 3 are equity accounts, 4 revenue, and then 6 expenses. Okay. When I used to work in industry, we had something similar to this, and I don't remember if we used 1 for assets or what. But having some type of consistent chart of accounts, some consistent numbering system is a really good idea. Okay, so that way if it starts with 1, I know it's an asset. If it starts with 6, I know it's an expense. Okay, and so when I worked in industry, we did something similar to that. And again, I don't remember if all assets started with 1 or 2, but we did start all of our expenses and all of our revenue accounts with the same number. Okay. So you can see, again, the chart of accounts is just a listing of all of our accounts and then their respective identification number. All right. So let's talk about debits and credits. So the term debit comes from the term debtor, and the term credit comes from the term creditor. And so what a debit is, I'm going to write out the accounting equation here with debits and credits on top of it. Okay, so I've got my assets equals my liabilities plus my equity. And so on top of the A, I'll put the D and then an arrow saying increase. So what this is telling you with D, the way to increase an asset is with the debit. The way to increase a liability or equity account, and I'll put a C with an arrow going up, is with a credit. Okay. The way to decrease an asset is with a credit. So I'll put a C here below the A with an arrow going down. And then the way to decrease a liability or equity account is with a debit, and I'll put a D with an arrow going down. This is what you need to know in order to do double entry accounting. So if you've had accounting in high school, you remember journal entries. This is what we use to do journal entries. We do debits and credits. And now journal entries is how we record those transactions. So remember, for example, I talked about paying a bill, right? We have a liability and we pay it off. How do we do that? How do we record that? Because part of accounting is that we have to record that transaction. That's a big part of accounting, is we have to record that transaction. The way we identify that transaction is we get the bill from the supplier. And then we have to pay it. Okay? And then we have to pay it. So how would the way that we record that transaction is through debits and credits. Okay? Through debits and credits. I'm going to go over this one more time. Assets equals liabilities plus equity. The way to increase an asset is with a debit. The way to increase a liability or equity account is with a credit. The way to decrease an asset is with a credit. The way to decrease a liability or equity account is with a debit. Okay? And what I have over here with this figure where it says account title, left side debit, right side credit, what I'm talking about is this is a general ledger account. So think, for example, cash. Okay? The left side of the general ledger account. So think about an account over here with debits going down the left side and credits on the right side. That's why you may have heard in accounting, debits on the left, credits on the right. That's what they're referring to is with the account title in the general ledger. Okay? The left side is always the debit side. The right side is always the credit side when we're talking about an account in the general ledger. All right, so think about it, cash. Now, the left side, the debit side, does that mean an increase in cash or does that mean a decrease in cash? Well, we have to look over here, our accounting equation, to figure that out, because we have to say, where do we put cash in terms of our accounting equation? Cash is an asset. How do I increase an asset with the debit? So the left side, so if this account title were cash, the left side, which is the debit side, this represents increases in cash. So we're getting cash, we're getting paid from customers. For example, customers have paid us. That would be recognized with a debit to cash on the debit side of the cash general ledger account. The right side, which is the credit side, that represents decreases to cash. How do I know? Well, we look over here with our accounting equation, our debits and credits. We can see that credit to cash means a decrease in cash. So credits on the right side of the cash T account represent decreases in cash. Now let's say that rather than cash, and I'll write this out, we have AP, which is an accounts payable, which we know is a liability. And we have the left side is the debit, and then the right side is the credit. But with our accounts payable, and this, by the way, is called a T account, so I'm going to start using this term. This is where it says account title right there, that figure. It's called a T account, and that's a way to visually represent an account in the general ledger. So a T account is the way, because it looks like a big capital T, is the way to visually represent an account in the general ledger. So I went over cash, and we said the left side, the debits, represent increases to cash. The right side, the credits, represent decreases of cash. What about AP accounts payable? Well, it's reversed. The right side, the credit, represents an increase in accounts payable. How do I know that? We'll look back over here with our accounting equation. How do I increase liabilities? Look up top, credit. So the right side, the credit, would represent an increase to a liability. The debit side, which is the left side of the accounts payable T account, represents a decrease in accounts payable. Okay? So that what I just discussed talks about debits and credits. It talks about T accounts. Now let's talk a little bit more about this idea of double entry bookkeeping, double entry accounting. What we're saying over here is this refers to journal entries. This refers to journal entries. And what we're saying with double entry accounting and journal entries is that each transaction, each time we do a journal entry, and we do a journal entry, a debit credit, to record a transaction. So I want to repeat that. We do a debit credit, a journal entry to record a transaction. So each transaction, we have to have a debit and a credit. And the total amount of the debits for each journal entry must equal the total amount of the credits. It doesn't mean that you can have 5 debits and only 4 credits, and that's not okay. That can be okay. It's just that the total dollar amount of the debits has to equal the total dollar amount of the credits for every single journal entry. And if that's not the case, assets will not equal liabilities plus equity. If debits do not equal credits, the accounting equation will not be in balance, will be imbalanced. It will be imbalanced. It will not be in balance, okay? So let's look over here on the next page talking about this is our assets equals liabilities plus equity figure, and I kind of just went over that with my own version of this. And remember, the way to increase an asset is with the debit. The way to decrease an asset is with the credit. The way to increase a liability or equity account, which is the right side of the accounting equation, is with the credit. The way to decrease liabilities and equity account, which is the right side of the accounting equation, is with the debit. So we increase liabilities and equity with credits. We decrease liabilities and equity with debits. We increase assets with the debit, and we decrease assets with the credit. We use debits and credits for journal entries, and we use journal entries to record transactions. Key part of accounting. Now, when I say over here, the normal balance for an asset account should be debit. That means typically, right, we would normally have more cash. We would have a positive balance in our checking account for cash. Right? If we have a negative balance, that means we've overdrawn our checking account. If you've ever done that before with your own personal checking account. If you had overdrawn your checking account, you would have a credit balance in cash, which is a problem. So we would typically think of cash or any other asset account as having normally it should have a debit balance. And similarly, liability and equity accounts, the normal balance should be a credit. So we should normally, if we had a debit balance in accounts payable, that would be strange. That means we've overpaid our liabilities, which would be odd. That wouldn't happen very much, right? We would hope the most it would be a 0. We wouldn't want to overpay, right? So normally, the balance for an accounts payable account, which is a liability, should be a credit. Same thing with equity. Credit balance is the normal balance for equity accounts. Now let's come over here, and we talked about before the 4 accounts that affect equity. Owner's capital, owner's withdrawals, revenues, and expenses. So how do I recognize an owner's withdrawal or owner's withdrawal going up? Owner's withdrawals have a positive influence on equity, right? How do I increase equity? With a credit. Okay? How do I decrease owner's withdrawal then? Is with the debit. Owner's capital, sorry. I meant owner's capital. How do I increase owner's capital with a credit? How do I decrease owner's capital with a debit? I think I was saying withdrawals. Sorry about that. I meant owner's capital. We'll look at owner's withdrawals now. I was looking at that one and talking about owner's capital. Sorry. Owner's withdrawals, the way to increase owner's withdrawals is with a debit. The way to decrease owner withdrawals is with a credit. Why is that? Because as owner's withdrawals go up, equity goes down. How do I make equity go down? With a debit. Okay, so that corresponds to up there. That's why as owner withdrawals go up, we recognize with that with the debit. And the reason that we recognize that with the debit is because as owner withdrawals go up, equity goes down. Revenues, as revenues go up, equity goes up. How do I recognize an increase in equity with a credit? That's why I increase revenues with the credit, and I would decrease revenues with the debit. As expenses go up, equity goes down. How do I recognize that equity goes down? Is with a debit. So how do I recognize that expenses going up? I recognize an increase in expenses with the debit and a decrease in expenses with the credit. Why do I do it that way? Because as expenses go up, equity goes down. How do I recognize that equity goes down? Is with a debit. So therefore, the way I increase expenses is with a debit. Okay, so I'm going to end this lecture video now and pick up on the next one. Thanks.